The market goes up and the market goes down. But what if I told you the biggest reason most investors lose money isn't the market at all? It's this, our own brain. Welcome everyone. Today, we're diving deep into the psychological traps that cause most investors to fail, and more importantly, how you can build the mental fortitude to avoid them. Understanding these hidden biases isn't just an interesting bit of trivia. It's the absolute first step to becoming a successful investor. Let's start with the big one, the emotional roller coaster driven by fear and greed. These two emotions are the puppet masters of poor financial decisions. Think about it. When the market is soaring, and everyone on social media is bragging about their gains, what kicks in? Greed. More specifically, FOMO, the fear of missing out. You see a stock going parabolic, and you jump in, buying at or near the peak, convinced it's your ticket to easy money. This is what we call buying high. But what happens when the party ends and the market starts to dip? The mood shifts, fear takes over. The headlines turn red, your portfolio value drops, and panic sets in. The same people who bought at the top are now terrified of losing everything. So what do? They sell, often at the very bottom, to stop the bleeding. They lock in their losses, they buy high and sell low, the exact opposite of what you're supposed to do. As the legendary investor Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. This cycle of euphoria and panic, driven by greed and fear, is the #1 wealth destroyer for the average person. But why do we keep falling for it? It's because of a few sneaky cognitive biases hardwired into our brains. Let's unmask the first culprit, confirmation bias. This is our natural tendency to seek out and favor information that confirms what we already believe, while conveniently ignoring anything that challenges it. Let's say you bought a stock you're really excited about. You'll probably spend your time reading positive news articles, watching videos that praise the company's future, and joining online communities of fellow enthusiastic shareholders. You'll filter out the warning signs, the weak earnings report, the new competitor, the negative analyst ratings. Your brain creates an echo chamber where your decision always looks like the right one, right up until the moment it isn't. To be a smart investor, you have to actively seek out the opposing viewpoint. You have to ask, why might I be wrong? It's uncomfortable, but it's essential for seeing the full picture. The next psychological trap that works hand in hand with confirmation bias is overconfidence bias. This is the simple, yet dangerous, belief that we are better than average. We overestimate our own knowledge, our abilities, and the accuracy of our predictions. After a few successful trades, it's easy to start feeling like the next market genius. You might think you figured it out, that you have a special insight no one else does. This overconfidence leads to taking on way too much risk. Maybe you concentrate your entire portfolio into 1 or 2 speculative stocks, or you start using complex financial instruments you don't fully understand. You confidently walk down a path, ignoring the clear warning signs because you believe you know better. The market has a brutal way of humbling even the most confident individuals. True wisdom in investing isn't thinking you know all the answers, it's knowing how much you don't know. Now, let's talk about the bias that keeps us stuck in bad situations, loss aversion. Psychologically, the pain of losing is about twice as powerful as the pleasure of gaining. This means losing $100 feels as bad as gaining $100 feels good. This powerful bias is why so many investors hold onto their losing stocks for far too long. We call them bag holders. You have a stock that's down 30, 40, maybe 50%. The rational decision might be to sell, cut your losses, and reinvest that capital into a more promising opportunity. But loss aversion whispers in your ear, just wait. If you hold on, it might come back to break even. If you sell now, you'll have to admit you made a mistake, and that loss becomes real. So you hold on, hoping and praying, while that deflating balloon of a stock shrinks further and further, sometimes to nothing. Letting go is painful, but sometimes it's the smartest financial move you can make. The opportunity cost of tying up your money in a losing position can be immense. So, we've identified the enemies, the fear and greed cycle, confirmation bias, overconfidence, and loss aversion. The good news is, you can fight back. You can build a system that protects you from your own worst instincts. Here's the antidote. First, and most importantly, have a plan and stick to it. I can't stress this enough. Before you invest a single dollar, You need a written investment plan. This is your constitution, your North Star. It should clearly define your financial goals. Are you saving for retirement in 30 years or a house in 5? It should define your risk tolerance. How much of a drop can you stomach without panicking? And crucially, it should outline what you will do in different market conditions. For example, if the market drops 20%, I will rebalance my portfolio by buying more stocks, or I will not sell any of my core holdings unless the fundamental story of the company has changed for the worse. Creating this plan when you are calm and rational prevents you from making emotional decisions when you are fearful or greedy. When the storm hits, you don't have to think, you just have to follow your plan. The second part of the antidote is to automate your investing. This is the single most powerful tool for removing emotion from the process. Set up automatic transfers from your bank account to your investment account every week or every month. This strategy is called dollar cost averaging. When you invest a fixed amount of money on a regular schedule, you automatically buy more shares when prices are low and fewer shares when prices are high. It forces you to be consistent and disciplined. You're not trying to time the market, which is a loser's game. You're just consistently buying, month after month, year after year. Automation acts as a circuit breaker for your emotional impulses. The decision is already made, and the system runs like clockwork, regardless of how you feel or what the headlines say. Finally, the third and perhaps most powerful part of the antidote is to simply zoom out. In the short term, the stock market is a chaotic, unpredictable voting machine. It bounces around based on news, sentiment, and emotion. It is easy to get caught up in this daily noise and feel like you need to react to every little movement. But if you zoom out, you'll see that over the long term, the market is a weighing machine. It reflects the steady, upward trend of economic growth, innovation, and corporate earnings. Look at any chart of a major index like the S&P 500 over the past 50 years. You'll see terrifying crashes and exhilarating bull runs, but the overarching trend is undeniably up and to the right. When you feel the panic of a market dip, remind yourself to zoom out. Remember that volatility is the price of admission for the long-term returns the stock market offers. Patience isn't just a virtue in investing, it's a superpower. So let's recap. The biggest obstacles to your investment success are psychological. It's the emotional roller coaster of fear and greed. It's the confirmation bias that blinds you to risk, the overconfidence that makes you reckless, and the loss aversion that keeps you clinging to your mistakes, but you can overcome them. You can build a fortress around your portfolio by having a clear, written plan, automating your investments to enforce discipline, and always maintaining a long-term perspective by zooming out. Investing is not just about charts and numbers, it's about mastering your own mind. It's a journey of self-control and patience. I'm curious to hear from you. Which one of these psychological traps have you fallen into before? Share your experience in the comments below. I think we can all learn from each other. If you're ready to become a smarter, more patient investor, please subscribe, like, and hit the notification bell for more videos like this. Thanks for watching.